Something fundamental changed in the silver market during 2025, and it has nothing to do with traders, speculators, or the kind of short-term volatility that typically dominates financial headlines. Because while most people were watching silver climb from around $29 at the start of the year to its current level above $65 per ounce, representing a gain of more than 120%. The real story was unfolding quietly in factories' supply chain meetings and procurement departments around the world. And that story is about industrial buyers who are not investing in silver, but consuming it in ways that cannot easily be reversed or substituted, creating a level of demand that is fundamentally different from anything the market has experienced in previous cycles. Before we go further, I need to be clear about something. I'm not a financial advisor, and nothing in this analysis should be interpreted as investment advice or a recommendation to buy or sell any asset. The purpose here is to examine the structural forces shaping the silver market and help you understand why industrial demand has become the dominant factor influencing price direction. Whether you own silver, are considering it, or simply want to understand where commodity markets are heading, these developments matter because they represent a shift in how silver functions within the global economy, and shifts of this magnitude tend to persist far longer than most people anticipate. As of mid-December 2025, silver is trading near all-time highs above $65 per ounce, having broken through resistance levels that held for more than 4 decades. But unlike previous rallies that were driven primarily by investment demand or monetary concerns, this move is being powered by something far more durable: industrial consumption that cannot easily decline even if prices continue rising. Because when silver is used in a solar panel, an electric vehicle, or a data center component, it is consumed, embedded into products where it performs functions that alternative materials simply cannot replicate at the same level of performance. And this consumption is accelerating across multiple sectors simultaneously, creating a convergence of demand that the supply side of the market was never designed to accommodate. To understand why this matters, you need to recognize that silver occupies a unique position among commodities. Unlike copper or aluminum, where large-scale primary mining operations can respond to price signals by increasing output, approximately 70% of silver production comes as a byproduct of mining for other metals, primarily copper, lead, and zinc. This means that silver supply responds slowly, if at all, to changes in silver prices, because mining companies are making production decisions based on the economics of their primary metals, not silver. And when you combine this supply and flexibility with rapidly growing consumption from sectors that view silver as a necessary input rather than an optional component, you create conditions where traditional market adjustment mechanisms break down. The numbers tell a clear story. According to the Silver Institute's latest data, industrial demand reached a record 680.5 million ounces in 2024 and is projected to exceed 700 million ounces for the first time in 2025. Meanwhile, global mine production has remained essentially flat at around 813 to 835 million ounces, despite prices that would normally incentivize expansion. And when you factor in investment demand, jewelry, silverware, and other uses, total consumption consistently exceeds supply by substantial margins. The market has experienced its 5th consecutive year of structural deficit in 2025, with the cumulative shortfall since 2021 approaching 800 million ounces. This is not a temporary imbalance that inventory draws can solve. It is a fundamental mismatch between what the industrial world needs and what the mining industry can deliver, and that mismatch is widening. What makes this situation particularly significant is the composition of industrial demand. This is not discretionary consumption that can be deferred during economic downturns or substituted away when prices rise. The 3 primary drivers, solar energy, electric vehicles, and data center infrastructure, are all experiencing rapid growth trajectories that are supported by government mandates, climate commitments, and technological imperatives that transcend normal economic cycles. Solar installations added 380 gigawatts of capacity in just the first half of 2025, a 64% increase from the same period in 2024. Each gigawatt requires approximately 1.9 million solar panels, and each panel contains roughly 0.64 ounces of silver, meaning that solar demand alone accounted for hundreds of millions of ounces of silver consumption in the first 6 months of the year. Electric vehicle production is following a similar trajectory, with global sales up 21% year over year through the first 10 months of 2025. And forecasts suggesting that the number of electric vehicles on roads will increase by 30% in 2026 to reach 116 million units. And these vehicles use 67 to 79% more silver than traditional internal combustion vehicles, with each battery electric vehicle containing 25 to 50 grams of silver in battery management systems, power electronics, charging infrastructure, and electrical contacts. When you project these adoption curves forward, the implications for silver demand become clear, and they are substantial. The data center revolution represents perhaps the most underappreciated source of silver demand growth, and it is accelerating at a pace that few market participants fully grasp. Because artificial intelligence is not just a technological trend, it is a fundamental transformation in how computing infrastructure is being built and deployed, and silver sits at the heart of this transformation. Global information technology power capacity has increased from less than 1 gigawatt in 2000 to nearly 50 gigawatts in 2025, a 5,252% increase that translates directly into demand for computing hardware and, by extension, the materials needed to manufacture that hardware. And this expansion is projected to continue at an extraordinary rate, with data center power requirements expected to double by 2026 and potentially quadruple by 2030. Understanding why this matters requires recognizing silver's unique physical properties. Silver is the most electrically conductive element on the periodic table, surpassing copper, gold, and every other material in its ability to move electrons efficiently with minimal resistance. In high-performance computing applications, where heat dissipation, signal integrity, and power efficiency are critical, silver is not just preferred, it is often the only practical choice. A single 500 megawatt solar array capable of powering a hyperscale data center requires approximately 300 metric tons of silver. And as technology companies race to build out AI infrastructure, these massive installations are proliferating globally, each one consuming silver in quantities that would have seemed extraordinary just a few years ago. The solar sector's silver intensity tells a similar story of structural, non-optional demand. According to research published in 2025, global solar deployment will need to reach between 18 and 63 terawatts by 2050 to meet climate objectives of limiting temperature increases to 1.5 degrees Celsius. Current installations represent just over 2 terawatts, meaning the world is in the very early stages of a multi-decade build-out that will require silver in quantities that challenge current understanding of supply availability. Recent analysis suggests that by 2030, solar installations alone could consume 10,000 to 14,000 tons of silver annually, representing 29 to 41% of total global supply. And critically, while research into reducing silver content per solar cell continues, overall demand keeps growing because deployment volumes are increasing faster than efficiency. Gains can offset them. The European Union is mandate to deliver at least 700 gigawatts of solar capacity by 2030, illustrates how policy commitments are locking in future silver demand regardless of market price. These are not aspirations that governments can easily abandon, they are legally binding targets with substantial political capital invested in their achievement. Similarly, China's recent $10 billion subsidy program for solar panel manufacturers is projected to boost silver consumption by approximately 5% over the next 12 months, and China's influence on global solar deployment means that this increase will have worldwide ripple effects. When major economies commit to green energy transitions at this scale, they are effectively committing to silver consumption at levels that the market has never before needed to sustain. In the automotive sector, the mathematics of the electric vehicle transition create inexorable demand growth. With 17 million electric vehicles sold globally in 2024, and that number projected to expand dramatically through the end of the decade, automotive silver demand is forecast to increase at a compound annual growth rate of 3.4% between 2025 and 2031. More significantly, electric vehicles are expected to overtake internal combustion engines as the primary source of automotive silver demand by 2027, and account for 59% of the automotive market for silver by 2031. The supporting infrastructure magnifies this impact further, with an estimated 28 million electric vehicle charging ports needed in the United States alone by 2030, each one requiring silver in its electrical components and connections. What ties these sectors together is their inelastic nature. This is consumption driven by technological requirements and policy mandates rather than price sensitivity. A solar panel manufacturer cannot simply reduce silver content below certain thresholds without sacrificing efficiency and competitiveness. An electric vehicle producer cannot eliminate silver from battery management systems without compromising safety and performance. A data center operator cannot substitute away from silver in critical computing components without accepting lower reliability and higher operating costs. This creates a category of demand that economists call price inelastic, meaning it does not decline proportionally when prices rise. And in commodity markets, inelastic demand meeting constrained supply is how structural repricing occurs. The scale of this repricing becomes clearer when you consider supply constraints. New silver mine projects require 7 to 15 years from initial discovery to commercial production, encompassing exploration, permitting, environmental assessments, community consultation, financing, construction phases. This means that even if exploration activity intensified dramatically today, new supply would not reach the market until the late 2020s or early 2030s, far too late to address current deficits. And exploration activity did not intensify. It declined substantially during the prolonged bear market in precious metals from 2011 to 2019, leaving a thin development pipeline that cannot respond quickly to current price signals no matter how attractive the economics appear. Additionally, declining ore grades across the mining industry mean that companies must process significantly more material to extract the same amount of silver they produced from higher grade deposits in previous decades. Average silver grades have decreased by approximately 25% over the past 10 years, increasing energy consumption, environmental impact, and operating costs across the industry. This is not a challenge that higher prices alone can solve. It is a geological reality that constrains supply growth regardless of market conditions. The supply side of silver presents challenges that extend far beyond simple production volumes, touching on fundamental aspects of how the metal is mined, processed, and brought to market. Because unlike gold, where primary mining operations focus specifically on that one metal and can adjust production based on gold prices, silver's status as predominantly a byproduct, metal creates structural inflexibility that many market observers underestimate. When a mining company is extracting copper from a deposit and recovering silver as a secondary product, its production decisions are driven by copper economics. If silver prices double but copper prices remain weak, that mine is unlikely to increase output regardless of how attractive silver margins appear, because the mine's viability depends on its primary metal, not its byproducts. This byproduct reality explains why mine production has remained essentially flat, even as silver prices more than doubled during 2025. Total mine supply for 2025 is projected around 835 million ounces, representing only a 2% increase from 2024, despite prices that would normally trigger substantial production responses in other commodity markets. And looking forward, long-term projections actually point to declines in silver output due to mine closures in key producing regions like Mexico and Peru countries that together account for a significant portion of global supply, but face political instability, regulatory uncertainty, and community relations challenges that complicate mining operations and discourage new investment. The geographic concentration of silver production adds another layer of fragility to supply chains. Mexico alone produces approximately 190 million ounces annually, making it the world's largest silver producer. But the country has experienced increasing resource nationalism, regulatory changes, and environmental restrictions that create uncertainty for mining operations. Peru, the second largest producer, faces similar challenges with community opposition to mining, permitting delays, and political volatility that can disrupt operations without warning. When such a large percentage of global supply originates from regions with these kinds of risks, industrial buyers become understandably concerned about reliability, and that concern manifests in behavioral changes that can amplify market tightness. The designation of silver as a critical mineral by the United States government in late 2025 represents official recognition of these supply vulnerabilities and their strategic implications. This designation brings silver into the same category as lithium, cobalt, and rare earth elements, materials deemed essential to economic security and national interests. The practical effects of this designation include potential strategic stockpiling, domestic production incentives, and trade restrictions that could further tighten global supply. More immediately, the announcement triggered precautionary buying and front-loaded shipments to the United States as industrial consumers sought to secure supply ahead of potential policy changes, effectively removing significant quantities of metal from global circulation and creating what analysts describe as a geographic bottleneck that exacerbated physical shortages in other markets. Recycling, often cited as a potential solution to supply constraints, faces its own limitations that prevent it from meaningfully closing the supply deficit. While recycled silver is projected to contribute approximately 195 million ounces in 2025, an increase of 24% from 2024, this volume remains far below what would be needed to balance the market. And much of silver's industrial use makes recycling difficult or economically unviable in the near term. Silver embedded in solar panels will not return to the market for 25 to 30 years when those panels reach end of life. Silver dispersed across millions of electronic devices in small quantities is expensive to collect and process, often costing more to recover than the silver's value. Photography, once a major source of recycled silver, has declined structurally as digital technology replaced film, eliminating what was historically an important secondary supply source. The physical market is showing signs of stress that validate these supply concerns. Inventories at major trading hubs, including the Shanghai Futures Exchange and London vaults, have fallen to multi-year lows, indicating that available metal is being rapidly absorbed by buyers. In early December 2025, the COMEX exchange experienced what some analysts called a physical vault drain emergency, where a substantial portion of registered silver was claimed for delivery, reducing immediately available supply and raising questions about whether paper markets can continue functioning normally if physical supply becomes too constrained. This episode highlighted the growing tension between futures markets, where large quantities of silver are traded on leverage, and physical markets where actual metal must be delivered to satisfy industrial demand. Forward-looking indicators reinforce the conclusion that supply will remain tight for the foreseeable future. Capital expenditure on new silver exploration and mine development remains well below what would be needed to substantially increase future supply, reflecting both the extended timelines for project development and the reality that silver prices, even at current elevated levels, may not justify the capital intensity and regulatory complexity of bringing new primary silver mines into production. Companies with established operations and existing permits have strategic advantages in this environment, but their ability to expand production is constrained by infrastructure limitations, workforce availability, and the technical challenges of extending mine life into lower grade zones of existing deposits. The cumulative effect of these supply constraints is a market that cannot easily rebalance through traditional mechanisms. Higher prices should theoretically stimulate new supply and reduce demand, bringing markets back toward equilibrium. But in silver, higher prices have minimal short-term impact on supply due to the byproduct nature of production and long development timelines, while demand from industrial sectors remains resilient because silver's performance characteristics make it difficult to substitute despite higher costs. This combination creates conditions where deficits persist even as prices rise substantially, and where further price appreciation becomes necessary to eventually force difficult substitution decisions or bring marginal supply sources into production. When you step back and examine the convergence of these factors, the pathway towards $75 per ounce or higher in 2026 becomes less about speculation and more about arithmetic. Because if industrial demand continues growing at current rates while supply remains constrained, the deficit widens further and markets will need to reprice silver to a level that either forces substitution in industrial applications or incentivizes new supply sources that currently appear uneconomic. Neither of these adjustments happens quickly or smoothly, which suggests that price appreciation may need to be substantial and sustained before equilibrium can be reestablished. Several major financial institutions have already adjusted their forecasts to reflect these realities. Bank of America raised its 12-month silver target to $65 per ounce after observing narrowing real yields and strengthening exchange-traded fund inflows. BNP Paribas has suggested silver could reach $100 per ounce by the end of 2026, as investors increasingly view it as both an industrial commodity and a safe haven asset amid persistent inflation and geopolitical uncertainty. These forecasts from institutional analysts, who typically err on the side of conservatism, indicate that mainstream finance is beginning to recognize the structural nature of silver, supply-demand imbalance, and its implications for pricing. The investor response to these developments has been substantial. Silver-backed exchange-traded products recorded 95 million ounces in net inflows during the first half of 2025 alone, already surpassing the full-year total for 2024. Total assets under management in silver-focused ETPs reached approximately $40 billion by mid-year, reflecting both price appreciation and continued capital allocation as more institutional investors position for what many now view as a multi-year structural bull market. This investment demand adds another layer of pressure on physical supply, as metal backing these financial products must be held in vaults, effectively removing it from circulation and reducing availability for industrial consumption. The behavior of industrial consumers provides perhaps the most telling signal about where market participants closest to physical supply believe prices are heading. Reports from procurement departments indicate that manufacturers are extending contract terms, building larger inventories, and in some cases, accepting higher prices today to ensure reliable supply tomorrow. This shift from just-in-time inventory management towards strategic buffer holdings reduces the pool of metal available in spot markets, amplifying scarcity and creating feedback loops where supply concerns drive precautionary demand, which in turn validates those supply concerns. When companies that depend on silver to keep factories running begin prioritizing supply security over cost optimization, it signals expectations of sustained tightness and potentially higher prices ahead. For those who measure investment performance over years rather than quarters, silver's current positioning presents what appears to be a rare convergence of favorable structural factors. Industrial demand growth that is mandated by government policy and driven by technological necessity, supply that cannot respond quickly regardless of price incentives, persistent deficits that have depleted above-ground inventories, and growing institutional recognition reflected in upgraded price targets and increased allocation. These are not conditions that reverse easily or quickly. They represent a regime change in how silver functions within the global economy. However, understanding direction is different from predicting timing or specific price levels, and that distinction matters. Markets rarely move in straight lines, and silver's historical volatility suggests that the path toward higher prices will include corrections, consolidations, and periods of uncertainty that test conviction. Geopolitical developments, changes in monetary policy, temporary demand disruptions, or unexpected supply sources could all create volatility that challenges those focused on short-term price action. But for those oriented towards structural trends rather than daily fluctuations, these episodes may represent entry opportunities rather than reasons to avoid exposure, because the underlying drivers remain intact regardless of short-term noise. The critical question is not whether silver reaches exactly $75 or $100 in 2026, but whether the current supply-demand structure can persist without substantial repricing. And the evidence increasingly suggests it cannot. With 5 consecutive years of deficits behind us, cumulative shortfalls approaching 800 million ounces, and industrial demand growth accelerating across multiple sectors. Simultaneously, the market is consuming more silver than it produces, with no near-term prospect of that changing. Eventually, price must rise to levels that either reduce consumption, stimulate new supply, or both. The fact that neither adjustment has occurred yet, despite a 120% price increase in 2025, suggests the ultimate clearing price may be significantly higher than current levels. Understanding these dynamics does not require perfect foresight or market timing skills. It requires recognizing what has changed structurally and positioning accordingly. Silver has transitioned from a metal with surplus supply and modest industrial demand to one facing chronic deficits and consumption growth, driven by the most significant technological and energy transitions of our time. Solar deployment, electric vehicle adoption, and artificial intelligence infrastructure are not temporary trends subject to sudden reversal. They are multi-decade transformations with enormous capital, political, and technological momentum behind them. And each of these transformations requires silver in quantities that historical supply frameworks were never designed to provide. For viewers who have followed this channel, the approach has always been to focus on understanding rather than prediction, on structural forces rather than price action, and on positioning that makes sense across a range of outcomes rather than betting on specific scenarios. Industrial demand is the real story in silver right now because it creates non-optional consumption that must be satisfied regardless of price, forcing markets to adjust through repricing rather than demand destruction. Whether that repricing happens smoothly or abruptly, gradually or in surges, the direction appears increasingly clear. And in markets, direction often matters more than timing, especially when the structural forces are this powerful and this persistent. The current price of silver above $65 per ounce in December 2025 may not be the peak. It may be a waypoint on a journey towards substantially higher levels, as markets continue grappling with the reality that industrial demand has fundamentally reshaped what silver is and how it trades. The question is no longer whether prices will rise, but how high they must go before the market can return to something resembling balance. And based on current trajectories in solar, electric vehicles, and data centers, that balance point appears to be well above where we are today.